Hi and welcome to BVTV. I'm Stuart Canning from MG's multi-asset team. Today I'll be discussing the macro outlook for the US and global economy. It's commonplace today to hear that the US is late cycle, and there's lots of concerns about slowing momentum outside of the US as well. Today I'm joined by Eric Lonergan, fund manager from the multi-asset team. Eric, what can we really know as investors about the prospects for the financial cycle, and how worried should we really be today?
Morning, Stuart. I think what's more interesting is investor psychology. And the constant preoccupation, both if you listen to policy officials, individuals, investors, about recession risk. So there has been a kind of permanent concern about recession around the corner. You may remember if you go back to February 2016, people were forecasting recessions with 60% probability, and this recession fear just hasn't gone away throughout this phase of economic growth. If you look at the actual facts, the delivery cyclically by the global economy is pretty spectacular. We're now looking at one of the largest phases, longest phases of expansion for the US economy. Certainly the labour market, it's one of the longest post-war phases of jobs growth. But even if you look at what's happening in China, still delivering very healthy economic growth. If you look at Europe broadly over the last few years, has been positively surprising. So I would say the facts of low inflation, very stable growth, are extremely positive. It's investor perceptions that are much more biased, and that is largely a reflection of the trauma that was caused still from 2008.
I mean, one thing we are told, on one hand we're told that recessions are unpredictable, but on the other hand many are looking at the US yield curve and the flattening there as a possible indicator of recession to come. How do we sort of reconcile those two? What information can we take from the yield curve?
Yeah, well, there's a lot of confused analysis and thinking about the yield curve. It's worth bearing in mind that arithmetically you should expect the yield curve to flatten whenever interest rates go up, short-term interest rates, because if you think, for example, of the 10-year yield is ultimately an expectation of an interest rate over 10 years. So by definition, as interest rates rise, you should get a yield curve flattening because this is the expectation of an average, and as the actual variable that you're calculating the averaging is rising, the curve is flattening. As a recession predictor, there's really very little information in the yield curve per se. What has a very high degree of information is the short end of the yield curve. In other words, when the market starts to predict that interest rates are going to decline, that has very significant information, which makes an awful lot of sense, because typically if a market is forecasting interest rates are going to decline, there is either already factual evidence of a problem in the economy and or it's being signaled by policymakers, as in some sense there's evidence that policy is tight or that policy is biting. So I think there is a huge amount of information if you look at interest rate expectations at the short end of the yield curve, but the very fact that the yield curve is flattening is in a sense just an arithmetical fact of the fact that rates are going up.
Okay. And what about people who say that the threat is not from the US economy itself, but from outside? So lots of people talking about slowing momentum out of China, the possibility of trade war impacts, and we've seen some big declines in emerging market currencies over the last couple of months. Should we take those as a red flag or as possibly a source of opportunity?
Well, I think there's two separate points I'd make. One thing is, I think one of the interesting things about all of these trade wars that one's observing is the unintended consequences. And I think a plausible unintended consequence of economic aggression by the Americans in particular towards China is that there is a reduction in the probability of a domestic Chinese economic problem. Now that might seem counterintuitive, but it isn't when you think that the Chinese have exhibited considerable control over the domestic economy through fiscal and monetary policy. They've been extremely successful at counter-cyclical intervention. If they're experiencing an external threat, it is highly unlikely they're going to allow the domestic economy go into recession. And we've already seen that they've brought forward fiscal and monetary easing. So I think one of the ironic consequences actually of this trade aggression towards China is it's reducing the probability of a domestic problem in China. And also I think Chinese assets, particularly the equity market, are extremely cheap. You've had now the best parts of 10 years of derating, which is very strong earnings growth with prices going nowhere. P multiples and valuations have improved very dramatically. Now you're getting fiscal and monetary easing. You could see some pretty spectacular returns out of Chinese assets. With respect to the rest of emerging markets, emerging markets, in my opinion, are a very odd classification. You've got totally different economies with very, very different risk and structural characteristics. The problem area has been very focused, which is largely those with current account deficits and dollar liabilities. It's logical with US interest rates going up, they should experience a problem. But now I think we've seen such significant reactions from their exchange rates that the real exchange rates are now at levels that we haven't really seen since the Asian crisis in the late 1990s. and the levels of carry that you're getting paid, the levels of spread you're getting in the bond market are making these markets starting to look attractive.
Thank you very much. Well, I guess that just leaves it for me to run through the main headlines we'll be looking at in the week ahead, as well as digesting the results of the Brazilian election. We've got data on the respective trade positions of the UK and Japan early in the week. We've got the Bank of England Credit Conditions Survey results. And then towards the end of the week, we have what could be an important inflation number out of the US, as well as Eurozone production. Thank you very much for watching, and have a great week.